Hello and welcome to the latest in NCP's series of informational videos. I'm Russ Lazaruk and am a portfolio manager with NCP. But before we start today's presentation, I'd just like to remind everyone that nothing that you hear in this video is an investment recommendation. Our hope is to provide some information and insights to the investment process in an easy to understand and maybe a bit of entertainment along the way if we manage to get some dad jokes in there. Today, I'm joined by my associate, Sam Colby. Sam. And our special guest, Robert Wilson of Picton Mahoney Asset Management. Our topic today is portfolio construction, which takes us to one of the foundational aspects of successful investing. But let's start with some introductions first, starting with you, Robert. And I understand you and your wife have just had your second child, so I do have to ask you, how are you doing with the sleepless nights as well?
Yeah, no, it's amazing. This summer, my world's gotten very tiny. We have our second daughter, Charlotte, and couldn't be happier. And she's doing well, and family's doing well. So it's been a lot of fun this summer in the Wilson household. Absolutely.
Yeah, and a few sleepless nights along the way, and
Par for the course, right?
yeah, yeah. And Robert, can you give us a little bit of a overview of what your role at Picton is? Because there is a brand, and I won't say a brand new. It's been in development for a while, but a new service that Picton has been rolling out predominantly for advisors and portfolio managers.
Yeah, absolutely. So I lead Picton Mahoney's portfolio construction consultation service team. And our remit is that we repackage capabilities of our portfolio managers, our risk analysts, our quant analysts into technology and consulting services for the investment community within Canada. Ultimately, our goal as a firm is to help investors achieve their goal with greater certainty, and a lot of that involves portfolio construction. And so we're trying to help make tools that previously were only available to the institutional community and the hedge fund community broadly available to Canadians through their advisors so that they can, achieve the retirement lifestyle they want and meet the legacy goals that they have for their families.
Great, thanks. And let's get into it now. And can you explain the key principles behind effective portfolio construction and how they've evolved over the years, and maybe touch a little bit on how it differs, if at all, from what we have traditionally thought of as asset allocation or strategic asset allocation?
Yeah, okay, that's a fantastic leading question. I mean, it's a big topic. Um, it starts with philosophy. So, what is the way you look at the world? And if we go back, portfolio construction got its start in 1952, modern portfolio construction at least. Harry Markowitz publishes Portfolio Selection, a 15-page paper that says, hey, if you can combine different assets that have some sort of diversification benefit, so they don't behave like one another, but they balance each other off, you could achieve much better results. And so that created modern portfolio theory, which is 70 years old today. It evolved then into this idea of like the endowment model, which is let's own a lot of different types of assets, and there's going to be this huge benefit that they all act differently. And to where we're at today, which is the idea of a total portfolio approach, which is to say that the world's a really complicated place. We can't have like 100 different assets because it's a lot to manage. We need to look through them to the pure underlying risks that drive their return and drive their risk. And if we can understand those pure underlying risks, we'll be able to achieve our goals across a broader range of scenarios. So like the example I'd give you is if anyone out there owns real estate, I'm going to tell you, no, you don't own real estate. You own interest rate risk and you own economic growth risk, and you're accessing those risks through real estate. And if you think of every asset you own that way, it's very empowering. You can make sure you have a proper diversification, and you can also make sure that your risks are intentional and scale appropriately. You're not just taking the same risk 10 different ways. So it's a very empowering framework that's being applied. It gets translated into asset allocation. Ultimately, you buy assets in your portfolio. That's how you express it. But to give you a perfect example, we run a multi-asset fund here. And when we did that fund, it's done a great job. It's made a ton of money for clients, right? And it's been a very smooth ride. We tend to take a lot less equity risk than other multi-asset funds. But that's because we can access economic growth through credit. We can access economic growth through commodities. And so we can take a more diversified approach to accessing economic growth. And so that kind of thinking, it's a different mental model, but we think it's incredibly powerful, and we try to, provide the tools so that can be applied for individual investors and, across the Canadian wealth landscape.
Yeah, yeah, it's interesting because I think my own observation, and certainly jump in here, is that probably the number one risk that most people don't realize they have in their portfolio. I mean, they'll see it in the bond side, but is interest rate risk,
Mhm.
which affects everything. And I pound the table internally and externally on it. It's the world is tied to the discount rate, which happens to be, in my mind, 10-year U.S. Treasuries. But I think we can argue how many angels dance on the head of a pin on that one. But I don't think most people do actually realize where their sources of risk actually are.
Oh, you nailed it with interest rate risk, right? Because so many portfolios are only designed to handle growth shocks.
Yeah,
So they got stocks. If there's an upside growth surprise, the economy does better than expected, they make a lot of money there. They've got these bonds that if there's a downside growth shock, they'll make money, but they're not protected against inflation shocks,
no,
right? If there's an upside inflation shock, the stocks and bonds trade the same way. 2022 reminded us of that. It didn't matter for 20 years, right? From 2000 to 2020, inflation had a one handle in the EKG of a potato, right? So
yeah,
you didn't care. But over the course of a retirement or over an even longer time period, if you have a legacy goal, at some point it will be relevant, and you need to be positioned for that. So, as a firm, there's different things that we try to do for clients. For example, we've constructed an inflation opportunity strategy that lets you play offense against inflation. And the way it does that is by investing into commodities. There's a ton of research on commodities are one of the things that help against inflation surprises. And then using different timing models, which are called CTA models generally. But the idea is that you figure out when do you lean in a little heavier and when do you lighten up. And by doing that, you could create some value. The other thing would be just more broadly is advisors like yourself that layer multiple layers of defense into the portfolio, right? So our goal as a firm, achieve investor goals, greater certainty. We've designed a number of products, whether they're absolute return products like our market neutral funds or our alpha funds, or these different products that are like designed to play defense without relying on interest rate risk, right? And so there's a number of ways that you do that. But in any given sell-off, you don't know what protection is going to work. So why don't you fortify your portfolio and have multiple layers of protection working to your benefit?
yeah, yeah. I think one of the things that most people aren't aware of is that we've certainly in the professional community we are, but a lot of private investors aren't aware of that we've had a one-way street on interest rates since September of 1981, when the 10-year peaked at 15.82%. I know this because I was doing some research yesterday. But it's been a secular downtrend in interest rates for over 40 years. And one I think could reasonably argue that we've seen that, and the world is starting to change.
One of the most dangerous things is things that you believe are absolutely true that aren't,
Yes.
right?
Yeah.
Like you have in any area, not just investing, but that's always super dangerous. So like
Yeah.
one thing I think a lot of people might believe that's not absolutely true is that when stocks lose money, government bonds perform really well,
Yeah.
right? I
Yeah.
think that's a foundational belief for a lot of people in the investment community. We decided to actually do the empirical research, and the answer is it depends. So
Yep.
from 2000 to 2020, when there was no inflation, and if there was a growth shock, the central bank could do a lot, right? Cut rates to zero, quantitative, all stuff. Government bonds were super heroic. There were 6 equity sell-offs in Canada of 15% or more. 6 out of 6 times the government bonds outperformed cash. On average, they delivered a 9% cumulative return. They were really, really good. From World War II to 2000, there were 15 sell-offs of 15% or more in Canadian stocks. 15 out of 15 times, government bonds underperformed cash.
Yeah.
They didn't work, right?
Yeah.
And so the idea is like you want to own some, but you don't want to just rely on that. There's more tools available, and that's where our firm is really focused. And can give lots of specific examples. I mean, a perfect example might be like our market neutral strategy, where the idea is it has similar volatility as a bond fund, like 4 or 5% volatility. It's got similar drawdowns as what you'd hope from a bond fund. I think max drawdowns is mid-single digit. But the way it's providing stability is not by taking interest rate risk. It doesn't care about the directions of rates. On average, it's made money when rates rise. On average, it's made money when rates fall. It is focused on security selection. If the stocks that we buy go up by more than the stocks that we sell, then we'll make money, and we'll provide diversification because we're not exposed to the market risks that are pushing around portfolios. And so, it goes back to like the golden kind of rule of portfolio construction, or the hope you have is, can you find 15 different things that all make more money than cash and each do it in a completely different way? And if you do, you've got the holy grail.
Yeah. And we're all still searching for it. We're getting closer, we hope, but yeah. Just changing it up a little bit. If you can't measure it, you can't manage it. And so what are some of the key analytical tools and metrics that investors should focus on when they're assessing the performance or the risk exposure of their portfolios?
Yeah, so this is like a favorite topic of mine. You could tell I'm probably a lot of fun at a party. But we wrote a whole article about 8 reasons why volatility is a poor measure of risk. But it's the most commonly used measure in our industry, and it probably because it goes back to 1952, the Markowitz paper. That's what he used. Back then, computers were the size of a room, and it's computationally easy to calculate. Every year at the CFA exams, people will calculate it with pen and paper, right? But it's got a lot of flaws, and so you want a holistic view of your risks. You want to do a couple things. And this would be how our multi-strategy investors think about it, and things like our alpha fund, or how they think about it like in our multi-asset funds, is like, okay, one, we got to make some adjustments. So a common metric for valuing portfolio is your Sharpe ratio, right? How much return are you earning relative to your risk? What is your quality of return? Well, we do an adjusted Sharpe ratio. So we're going to penalize your tail risk, which is the idea that if you make lots of small wins but occasionally blow up, that's not good. So we want to penalize if that's the way your strategy behaves. And then we want to penalize a wide dispersion, which just means if you have lots of months where you make a lot of money, lots of months where you lose a lot of money, that's not as good as making money more consistently. And once you apply those penalty factors, you get a much better measure of quality of return for a portfolio. So we think that's really important, is those adjustments. We want to look at what we call the beta footprint, okay, which is those pure underlying risks that drive a portfolio. We've identified 9 risks that explain about 90% of the risk in the typical globally diversified portfolio. It's interest rates, it's credit, it's different types of commodities, it's developed and emerging stocks, it's the US dollar. And it does a really nice job of making things as simple as possible and no simpler. Okay, so you avoid unintended risk, make sure the intentional risk is scaled appropriately. What's really nice in our multi-asset strategies is if you can have insights about which risk to take. So we have an economic cycle timing model, right? And all that is saying is like, do we have a sense if we're going to be going into a recession, or if growth will accelerate, or if it's going to decelerate? Well, what probability do we place on each of those things? And you do it, it's really cool. It's called regime distance modeling. How similar are the indicators today to how they were in the past? And then that can give us some edge, hopefully. And that's worked really well for multi-asset strategy. So having a beta footprint, what are your risks? Like having a risk model for your portfolio. It's not just how much risk you're taking, but where is that risk coming from? And being able to answer that question as simply as possible, we think is important. We believe a lot in conditional analysis. So much of our industry is focused on averages, but averages are useful while they still hide a lot of information. So statisticians have a joke, right? If you put your head in the oven and your feet in the freezer, your average body temperature is fine, but you have a big problem, right? It's the same for your portfolio. So let's break it down. How do you do when rates are rising? How do you do when they're falling? What about when stocks are going up or down, or commodities or credit, et cetera? And that conditional analysis can make sure that you haven't built a portfolio that only does well in one state of the world. Because what if the future is different? The future is unknowable, right?
Yeah.
So that conditional analysis, that beta footprint, the point of all that would be you want to measure not just how much risk you're taking, but how concentrated your risk is. And especially for anyone listening to this, like, if you're turning, 65 and sometime next 5 years, or you've recently retired, you're in that critical window, right? There's two reasons your plan could fail. Number one, you don't make enough money in the long term. You need to make enough money in the long term. But number two is if you take a large loss early in retirement or right before retirement, even if your long-term return is high enough, the plan still fails. It's called sequence risk. And the way you manage sequence risk is diversification. And the way you diversify is you understand the risk you're taking. So beta footprint to me is like, if I could only bring one analytic with me, it would be the beta footprint.
Yeah. Yeah. And I think, for so many private investors, they don't realize that sequence of return, risk, and that large drawdown, especially in the early years, can seriously impact. And having that narrower range of returns, so you're not taking big wins and big losses, but keeping it tighter, certainly mitigates. Nothing's ever 100%. We're never gonna bat 1,000. Otherwise, I would be probably not be on this webinar. I'd be in Tahiti or someplace like that. But yeah, the ability to mitigate, especially for people that are close to or in retirement, being able to mitigate that risk, and it's not necessarily going to more fixed income, because you do take on risk there. What do you think the most common mistakes investors make when it comes to portfolio analytics, and how can they be avoided? I think we've touched on it. I think the Sharpe ratio. A few people look at the Sortino. Those are the common ratios people look at. But what are they missing?
One is being too married to one specific number.
Yeah.
So I always love, if I can have 3 or 4 different numbers that are telling me the same story, I can have more confidence in what I'm seeing. The other thing is spending time on the data, because if it's garbage in, it's garbage out.
Yeah.
And it's probably the most time consuming part is getting the best data and working with the data. So for example, when we work with private asset strategies, and we think those are an important piece of the mix, for some investors that they can handle liquidity risk. It's understanding, that they're not marked to the market. They're not showing the daily volatility of the assets that they own. So the idea of like de-smoothing the returns, which is to recognize that they're marked, like let's say it's real estate, they're marked to appraisal, and appraisals are biased by previous appraisals, so the prices move more slowly, or they're being marked to a model. And so how do you adjust the published returns so that the data you're working is more reflective of the risk of the asset you're in? And it won't help you pick the right manager to go with, but it can help you figure out how much. Like,
Yeah.
do I want to do 4% or do I want to do 10%? And so thinking a lot about the data is really important. The other thing I think is important to think about trade-offs. So if you don't have a crystal clear picture in your mind of what your goal is and what outcome you're seeking to achieve, then analytics can't really help you. So investing the additional time of like, what is your beliefs? What are you trying to accomplish as your goal becomes really important. So for example, if you wanted to amplify the returns of investing in equity, we have a 130-30 fund. Our active extension strategy, it's fully invested in the stock market. It buys $1.30 of stocks, sells 30 cents of stocks. So we can give $1.60 of manager skill for every dollar of market risk we take. The analytics would be like, oh, that has a lot of equity risk. Well, good, that's intentional. Good, the product's doing what it said it's supposed to do. But if you looked at like something that we would offer that's a diversifier, like our alpha strategy, it's going to show zero market risk. So the same analytic is completely different for the two products. One's not better or worse. It's like, what is your goal? What is this thing meant to do in the portfolio? And so making sure you understand the purpose, and then the analytic is aligned to the purpose.
Yeah, and I think that's key. I think we are big believers and practitioners of goals-based asset allocation here at NCP, building off of work by JP Brunel. Um, and so it's a bit of a roll-up exercise where we identify each goal and assign a an asset allocation to that goal, and then rolls up to an overall asset allocation. Short-term income goals have a very different asset allocation than your long-term legacy goal, whatever that may be. I think the other, just picking up on another point that you made of, when we see, especially private assets that aren't marked to market, I don't think most people realize that even if it's not marked to market, there is a market there, and that market is often driven by the same drivers that some of the publicly traded and more liquid assets are. Private equity, I think, which we are big believers in for a lot of reasons, and run our own private equity portfolio. Um, um, if that private company was put up for sale today, it would be subject to much the same drivers as a public market vehicle. Perhaps the one that would be stripped out would be fund flows, because it's a very tight specific market, as opposed to fund flows that we see, whether it's into ETFs or funds or all the rest. Let's change it up a little bit here. I'd like to move on to some more investment versus portfolio questions, but I think before, because it's a wide open definition to a lot of people, how would you define alternative investments?
Yeah, so that's a great question. The easy answer would be like anything that's not traditional investments, right? So
Yeah.
traditional investments
Okay.
would be like cash, stocks, and bonds. But what I would say is that there's two main buckets. There are alternative assets and alternative strategies. Okay, the buckets are pretty broad based. So if you actually look at how they get subdivided into little components, it can be quite granular. So the way I like thinking about it is in a goal-based framework.
Mhm.
Just backing it out a little bit, the alternative assets would be things like real estate and infrastructure and commodities, and then the alternative strategies would be stuff like hedge funds and liquid alternatives and different things like that. But the goal-based framework, essentially, you have two main buckets. There are enhancers and there are diversifiers, right? So alternative strategies or assets that are enhancers, they're taking the same risk as the risks in your traditional portfolio, but trying to deliver a better outcome. So they could be amplifiers. They're trying to take on, say, equity risk, but make you more money, like a private equity or a 130/30 fund, like our active extension. Or they could be risk mitigators. They're trying to take on the risk, but deliver more downside protection, like a long short credit fund might invest in the credit market, but seek to protect your downside, or a long short equity fund. So that's the enhancer bucket, is like it's going to do stocks and bonds better, hopefully, if you're with someone who's skillful and thoughtful and makes good decisions for you. The second bucket would be diversifiers. So these are strategies with a completely different goal, or assets with a completely different goal. They're trying to meaningfully outperform cash without taking on interest rate, credit, equity risk. So they're trying to beat cash without taking the risk you already have in your portfolio. And there we've got two buckets: portfolio stabilizers. These are often used instead of bonds. They're going to have relatively low volatility. They're going to be good diversifiers against stocks and bonds, and they're going to try and beat cash by a couple points a year. I would say that our market neutral strategy is very emblematic of this approach. We've done that since before 2008, and you can see kind of like what has happened in the financial crisis and during 2020 and 2022, et cetera, of like trying to beat cash without taking market risk. And then the other would be what we call alpha engines. So these are diversifiers that have a bigger risk budget. They're trying to put up like equity-like returns without taking any market risk. And so stuff like hedge funds that are using like 5 turns of leverage, so to take these uncorrelated small bets and try to generate big returns off them, that kind of thing. Yeah, so goal-based framework, I think, is the way to go, and judge the strategies based on how they can contribute to the outcome you're seeking to achieve.
Yeah, yeah. And I think I think the most important point that I bring away from that is make sure you're clear of what your goal is and what you're actually trying to achieve. And it starts from your to your overall goal, but what is the goal of this? Is the goal of this part of my portfolio and what I'm adding in to lower volatility, or is it enhance my returns? And need to be very clear on why you're putting something in.
And what's so great, for investors is in the industry we talk about this democratization of access to alternatives. So now all of a sudden, like a lot of strategies that only were available to institutions are available to you as a high net worth individual. You have access to hedge fund managers and commodity traders and private equity funds and all this stuff has now been packaged in a way to make it accessible. But that means that focusing on what your goal is and how it's going to help achieve the goal becomes really important because the stuff does do what it says on the tin. You just got to make sure you're buying the right tin.
And understand what you've bought and what it's going to do. So just moving on a little bit here again, how do alternatives actually fit into a traditional portfolio? And I think we've kind of touched on this. And what specific benefits do they bring in terms of risk and return? I think we've kind of touched on most of these, but maybe just sort of synthesizing it down a little bit.
Yeah, I think one thing is that if you're going to invest with a skillful investor, you want to make sure they have as many tools available at their disposal as possible. And so that's relevant when it comes to private assets, where you're actually taking like a control position in a company and you can really affect change. And if you have like operational excellence and best practices for them to implement and change their capital structure, like there's so much you could do if you're skillful. It's also very relevant on the liquid side, right? So you think about like our long short equity fund, right? We buy $1.50 of stocks, we sell $1 of stocks, we have 50 cents of stock exposure. But we have $2.50 out at work for you. So if we're skillful, we have 2.5 times more opportunity to create value for you, either make you more money or protect your downside or whatever. But where it gets really interesting is if you look at the stock market, it's very top heavy. Like so much of the stock market is in the 10 biggest names. And then you've got all these stocks that are like less than 0.5% weighting in the market. Well, what if I'm a really skillful investor and I have a view on that company, but it's a negative view? If I'm handcuffed that I can only buy stocks that I like, the biggest negative view I can express is to not own it.
Yeah.
So maybe I've expressed a 0.2% underweight, or a 0.3, whereas if I like a stock, I might own an extra percent, 2% or 3% of it. I've expressed 100, 200, 300 basis points of view, like 10 to 15 times more.
Yeah.
Well, if I can go short, why not be negative 1% in the stock or negative 2% in the stock and express the view to the same side, especially as one of my highest conviction views? Why shouldn't I do that and have a broader opportunity set to express my skill across? And if I can do that over time, your money can work harder for you and it can work smarter for you. So that's exactly what, the hedge fund community is delivering, especially through like making it accessible through liquid alternative products like that long short strategy I just mentioned. That's available as a mutual fund. That's available as an ETF. Like this stuff is really broadly available, where before, it was limited to the institutional community.
Yeah, yeah, and that's been a sea change over the last 5 or 6 years, and I think investors, but also I think advisors are still wrapping their heads around it. I think as the singular focus that we've had for the last decades, well, maybe forever on return, and then occasionally get freaked out when we've got a large drawdown. Takes the focus away from those once again those asset classes or the investments, the enhancers or et cetera, or the diversifiers to smooth out those returns. And again, going back to sequence of returns for people that retired, or making sure that you're properly aligned with your goals. What are the risks when investors incorporate alternatives into their portfolio? You can do it the right way. You can do it sort of okay, or you can make a mess of it, and we're all guilty of all three. Um, so what are the risks? What do they really need to pay attention to when they're starting to incorporate alternatives into a portfolio?
Yeah, one of the biggest missteps that I've seen is a new strategy will come out that's been around for a year or two, and it's made money almost every single month and been super consistent. And it could be a good strategy with a skilled manager, but people end up buying way too much of it because they're just looking at that narrow window.
Yeah,
So having a broader context, understand, okay, what style of strategy is that? And, strategies have been around, like private equity goes back to the 1980s, hedge fund investing goes back to the 1950s. Like, we kind of know how the different types of strategies behave, right? And so then you can buy the right amount. And so you don't end up in this situation where you got something that's like, it makes a little bit of money every month, and then once every 3 to 5 years, it loses 30%. Like, unless that
yeah,
was what you were looking for. So I would say having the broad context of like, how do strategies behave over time and not being narrowly focused on like the near term is really important. The other thing I would say is, um, often a certain type of strategy can be very appealing to someone. They have a positive experience with a certain type of strategy, and then they go and find like 5 things that are doing the exact same thing.
yeah,
And the reason I'd say that's a mistake is the first dollar you put into something has the most outsized benefit to you, and then each additional dollar incrementally is less beneficial. So instead, can you find three or completely different things that all are going to add value, do it in different ways? That'll be way better than finding three people doing the same thing for you.
yeah.
And we see that we see that that quite often. It's very natural as you have a positive experience with something to look for more things that are just like that.
Yeah, yeah, and we see that consistently throughout portfolios, even before liquid alts and alternative strategies became more available. We would see people um, thinking that they're achieving diversification by having three long only managers in the same, three Canadian long only managers, and think that they've diversified, whereas they may have diversified by managers and skill levels to a certain degree, but at the end of the day, they're all in the same market. They're basically buying all the same stuff except in different proportions. And yeah,
You've got depth of diversification, but no breadth of diversification.
yeah,
And even worse, there could be a cancellation effect.
yes,
One guy likes Apple, the other guy doesn't, and now you just built an expensive market exposure that you could have done cheaper. So it's depth of diversification is important, but like the low hanging fruit is this breadth of diversification. And just on that point, right? I love explaining portfolio construction in the context of our alpha fund because it puts all our thinking about like how do you actually diversify a portfolio, right? So first would be like each building block you needs to be of high quality on a standalone basis, right? Like each strategy that becomes part of your diversification, it should have a good quality of return, make nice money compared to the risk it takes. Each strategy on a standalone basis should diversify stock and bond risk. But the third piece, and this is the piece I think that's often missing, is the different parts of your diversification approach should diversify one another. So they're not all doing it the same way. So you don't buy three event-driven equity strategies or three event-driven credit strategies. You go, let's get some event-driven equity, let's get some event-driven credit, let's get some market neutral or absolute return, and let's have these different building blocks that on a standalone diversify, but that diversify one another. That way, if there's ever a year where one style's out of favor, it doesn't ruin your whole program, right?
yeah,
And I think that often is like um, the missing piece is you've got a bunch of diversifiers, but then they all sell off at the same time because they weren't diversifying one another.
yeah, yeah. Well, which was classic 2007, 2008 correlations all went to one. It didn't matter, virtually didn't matter which asset class you were in.
And that's why I think the risk modeling is so important is to understand, hey, is this actually a diversifier or is it just repackaging the risk I'm already taking in a different way? Right? Like looking through and be like, does this thing care what rates are doing? Does this thing care what the stock market's doing? If it does, that's fine. But just to know what it is,
Yeah,
it could still add a ton of value because they're skillful investors that are tapping into opportunities. But just know that, if you're buying it because you want something that's not going to act like stocks and bonds, No, that is. So like I love that beta footprint again. That's why it's my one analytic if I can only have one.
Yeah. Yeah. And again, so much stuff is tied back to interest rate risk that we don't realize. Yeah.
Yeah,
Yeah.
everything is driven
Yeah.
by you explained it the best earlier on when we were talking about discount rates, right?
Yep.
Like that drives everything.
Absolutely. Yeah. Um, can you share a few real world examples or case studies where incorporating alts has significantly improved portfolio performance? And I'll say performance in the broader context of not just return, but also how to, achieving that return with a level of risk.
Yeah, well, a very practical example, and this is nice because it actually doesn't require being particularly skillful, would be for taxable investors, right? So the way the Canadian tax code is set up generally is that things that are really risky have smaller tax bills and things that are really safe have bigger tax bills. So like cash is interest and half of it at the highest top bracket goes to the government. Equities are capital gains, and at the highest tax bracket, about a quarter of it goes to the government, right? So they incentivize you, if you want to be tax efficient, you better take a lot of risk. Well, alternative strategies allow you to invest in things that are less risky, but that have a good tax outcome. So a good example from our product lineup would be that we have our arbitrage fund, right? Which is investing in equities. So what that fund does is a company announces they're going to acquire another company. Okay, so maybe they're going to buy some company for $100 a share, and the stock prices pops up. Maybe it pops up to like $98, but it doesn't go exactly to $100 because there's a chance that they may not consummate the deal.
Yep.
And the holders of that stock don't want to kind of take that risk. They're not experts in whether or not deals are going to close. But within the hedge fund community, there are fantastic investors at experts. We've got a few of them within our own team. They run a very successful strategy doing this. So they'll buy the stock at $98 and hold it till the deal closes at $100, and they'll make $2. But
Yep.
it's not interest income; it's capital gains because it's the stock price going up.
Right.
Right. And if you look at how a strategy like that behaves, it tends to have similar level of risk as a bond fund. Right.
Yeah.
So if all of a sudden you could have a similar amount of total risk, but the government is only a quarter share partner instead of half partner, you end up being way better off. So you don't even need to outperform; just the same performance would leave more money in your pocket. So that's a great
Yeah.
example for investors that have allocations to more conservative holdings. Typically, they get penalized by the tax code, but there are alternative strategies that help mitigate that. So I think that's like a great example. Investors have benefited for years and years from that.
Everybody loves a bit of tax alpha. Yeah. Um, how does the investing landscape impact your fund management and investment decisions? We live in an ever changing and evolving world, sometimes faster than we would like.
Yeah, no, that's a really great question. So there's two aspects. So within our strategies, and I'll use the multi-asset because that one maybe plays the most into the economic environment. We have what's called the economic cycle timing model. Okay. And so the idea is that if you look at different assets like stocks and bonds and credit and commodities, they act very differently throughout the different phases of the business cycle, like in a recession versus a period of accelerating growth or decelerating growth. So what you do is you look at these forward-looking economic indicators. Like there's a number of different metrics that could help predict what part of the business cycle we're going into. And you say, how similar are these things to different times in the past? And then based on that, you can say, you know what? There's a 30% chance we're going into a recession and a 40% chance that growth will accelerate, and et cetera, et cetera. And then you figure out how do these assets all behave in those different scenarios. And then based on that, you make your decision, okay, right now we're going to be overweight this or underweight that, right? And so that's nice because it's a systematic, quantitative, and repeatable approach. But then there's the risks that are going on that maybe can't be explained in that way. And I'll give you a good example, would be like political risk, geopolitical risk. Right now, we are living in a time of elevated geopolitical risk. Well, the last thing you would want as an investor is to have your assets stranded because of a geopolitical event, right? Let's say you were investing in emerging markets and you had large allocations into Russia prior to the Ukraine war, right? Well, there's some sort of non-zero risk, for example, that if you had large exposures to certain parts of the world, which we are on a less friendly basis with, that your assets could get stranded in parts of emerging markets. And so one of the ideas is like, well, why do you invest in emerging markets? There's a diversification benefit against developed markets. And so you analyze that, well, what does that actually come from? A lot of it comes from that a lot of these emerging markets are commodity exporters, whereas the developed markets are generally commodity importers, right? Well, Canada's a commodity exporter. So a way that you could reflect that geopolitical risk would be to say, you know what, I'm not going to just have 3-4% Canada in my portfolio. I'm going to have meaningfully more than that because I can allocate assets that others are allocating to regions where they may get stranded.
Yeah.
You know, probably won't, but they could. I can allocate those assets into Canada and get that same commodity export or diversification benefit without taking on this stranded asset risk, which is maybe a risk that I'm not being paid for taking, right?
Yeah.
So anytime you can do something like that, where you take an outcome that's, yeah, it's low probability, but very high impact, and you can kind of figure a way around that. The more you do stuff like that, the better you protect yourself, especially for the long term, because over the long run, lots of things are going to happen, right? We don't know what they are, right? Like and so the more you can get those ones out of the way, it's kind of a nice thing.
Yeah. That sort of really sort of covered my next question. So I think I'm just going to skip over here and I'll see if you can dust off your crystal ball, and we won't hold you to any predictions because nobody knows what's going to happen tomorrow, let alone next year. But where do you see the biggest opportunities and risks in the next 12 months and longer term?
Yeah, so that's a really interesting question. It's a difficult question.
Yeah.
One thing I would say is that there's a heightened level of uncertainty. So if you think about it, if you're bullish, it's easy. You buy more stocks.
Yep.
If you're bearish, it's easy. It's like maybe it's like more cash or government bonds. What do you do when it's uncertain? Well, the playbook for uncertainty is diversification. So that would be the first thing, is like, really right now there's a bull market in diversification. The second thing I would say is just look at what happened through the first half of the year. So to help investors with their alternatives allocations, we have 11 proprietary indices tracking liquid alternative investments, so strategy and goal-based indices. The market neutral equity index outperformed the TSX in the first half of the year. Okay, well, why is that? And does that make sense? Market neutral equity loves a high dispersion between winning and losing stocks. That's happening right now. Market neutral investing loves low correlation between stocks. That's happening right now. So it's a target rich environment for that style of investing. So the category as a whole, including the strategies that did poorly, the category as a whole outperformed the stock market in the first half of the year. Skillful strategies did even better, right? So I would say that that's really interesting, that opportunity within the market. And what's kind of nice about that opportunity is people talk about the concentration risk in the stock market, right? The 10 biggest stocks are like such a huge part of the global market now. Well, strategies like that help you to lessen that that aspect. So it's not necessarily a call on asset class, but if you think about it, stocks overall are relatively expensive. Credit spreads overall are relatively tight, and the reward for taking more rate risk is not anything because the curve is flat. So it's not like there's these layup trades where like, oh man, like I've got a investment thesis here and things are cheap, like it's all lined up. It's like, no, you might have an investment thesis, but on the other side of that is that things are a bit expensive. So you put your capital to work, you find attractive opportunities, you recognize that if things are a little bit expensive, then you're not putting your foot all the way down on the gas pedal, right?
Yeah.
You're driving kind of safely. You're being a defensive driver, if that makes sense.
Yeah.
And perhaps it's about opportunities within asset classes instead of specific asset classes.
Yeah. And a lot of it comes down to process and sticking to that process and discipline, which is where skillful managers outperform over time. It no longer there's always a certain amount of luck in everything that we undertake, but I mean it strips out the luck factor to a large degree just by making sure you've got those processes and they're revisited and you've done the analytics and yeah.
And what I love is if you are doing the portfolio construction work, right, you could have a better strategic mix. Like you've got the breadth of diversification, not just the depth.
Yeah.
It's like if you were doing a 100-yard race and you get a 20-yard head start. So in the years where you get those tactical calls right, which we won't get them right all the time, you get them, if you can get them more than half the time, you got a spot in the Hall of Fame, right?
Yeah.
You'll do amazing. The years where you get them wrong, maybe you can still be with the crowd and have done just fine because you've given yourself this head start by having a better strategic asset mix.
Yeah. Yeah. Sam, we've rattled on here for the last hour or so.
Yeah, that was great.
Questions?
What would be your advice to people dipping their toes into like the alternative strategies for the first time?
Yeah, I think that step one is understanding the goal, right? Yeah. So using the goal-based framework of, are we doing this to enhance our outcome from buying stocks and bonds, or are we doing this to diversify and add in exposure to assets or strategies that don't care about what stocks and bonds are doing? Yeah. And then secondly, I would say is, things are not an all or nothing decision. Like if you recognize that over time, you're going to want to have a meaningful program in place, you don't have to do it all on day one. You can sit down with your advisor and say, you know what, over the next 3 years, here's where we want to get to. And how do we get that done over time to get to that target level? There's nothing wrong with taking an incremental approach. And then the last thing I would just say is you want to make sure that you are focusing on high quality partners because part of the trade-off is more of the result is going to come from the manager's skill and less of it's going to come from what the market's doing. So having the highest quality partners in place to implement those programs for you is really important.
I think the world of alternatives actually dovetailing quite nicely to people that have up to this point gone down the indexing road, and because they're capturing cheap beta, and there's nothing wrong with that, but they've also exposed themselves to an awful lot of risks that they may not be aware of. And so it's that breadth of diversification as opposed to depth, which you would automatically get through indexing.
Yeah.
Well, I think that the rationale for indexing and for alts often is the same thing, is that those are the two product categories that are the most efficient use of your fee budget. Indexing because you're getting the cost down as low as possible. Generally, there are things that are lower cost also other than that, but generally, and alts because you're paying alpha prices for alpha return, right? Yeah. And that's the thing that's rare and precious. And so those two product categories tend to be the most efficient use of your fee budget. So we actually see a lot of the investors that are some of our, let's say, larger investors, they actually do both because they see that pairing and they save money where it makes sense. They spend money where it makes sense. And, but I agree with you 100%, just doing the one, your retirement and your legacy goals are too important to leave them up to the level or direction of interest rates and the equity market.
Yeah.
So it's to me, that's not prudent. That's a bit rolling dice that, and not making use of all the amazing research and expertise that our investment community has developed over time.
Yeah. The next black swan event could well be just a secular rise in the next 40 years of interest rates, as opposed to the last 40 years where we've seen 40 plus years where we've seen rates coming down.
Yeah, congratulations, you got the same return as the market, and your plan failed.
Exactly. Exactly.
Yeah.
Well, thanks very much, Robert. Really enjoyed this. I hope everybody else out there that gets an opportunity to watch this gains as much as we have. Great. Thank you.
Thank you. Great speaking with
Good.
you guys today.